Kia ora, and welcome to the CoreLogic Property Market Update for October 2020. How good is it to be back at Alert Level 1 nationwide after successfully eliminating COVID-19 from the community for the second time? Not that there was any meaningful impact to the property market as we negotiated the alert levels this time around. Sales volumes in September were nothing but exceptional. Our projected final sales figure of 9,666 is the single strongest month in over 4 years, and it places it 6th in the list of most active months dating back to May 2007. Of course, there has likely been some catch-up on prior months, given year-to-date volumes are essentially at parity with 2019 volumes. But considering the current economic environment, there's still some impressive stats, especially if you consider how many more sales might have occurred if more property was available for sale. Because we shouldn't forget, we remain in a market where turnover is constrained by all-time low listings levels. This persistent undersupply is contributing to the growth in property values. According to the CoreLogic House Price Index, nationwide values have now increased 0.6% since we saw the impact of COVID-19 creating some nervousness in the market. Growth in Hamilton over the same period has totaled 2.8%. But it's the provincial centres that have shown the greatest resilience, with both Gisborne and Rotorua seeing values grow by more than 5%. Even in Queenstown, where we know property demand has reduced, there are signs the drop away in values may have stopped, with a 1.2% lift in the last month. When we dig a little deeper, and especially pay attention to the commentary coming out of the Reserve Bank at the moment, it's not all that surprising to see such strength. The Reserve Bank's transparent mandate has been to ensure cash and confidence to the economy. Record low interest rates, access to credit, and a bounce back in consumer confidence has been a recipe for stronger property market conditions. Now, despite the hyperbole, we don't want to get too carried away with this seemingly bulletproof property market. Tough economic times remain in front of us, most notably the forecast lift in unemployment. And while the forecast peak of 8% is lower than previously expected, the road to recovery has elongated, which could flow through to the property market as demand reduces due to fewer people being able to sustain their current living situation. We'll get official figures on the unemployment rate for Q3 in early November, but expectations are for the figure to be much more real than Q2, when fiscal support through the lockdown disrupted traditional methods of measuring people looking for work. Recipients of job seeker support provide us an excellent guide to that likely unemployment rate. And with about 6.5% of the working age population collecting this benefit at the end of September, it seems sensible to expect the figure to come out in this vicinity. Expectations are for the rise in unemployment to disproportionately impact renters, as opposed to homeowners, due to their higher participation in industries affected more greatly by the COVID-19 induced economic downturn, such as tourism, hospitality, arts and entertainment. So indirectly, property investors should be prepared for the flow-on effects to potentially reduce rents and lift vacancy. But recent investor activity flies in the face of all that. Long-term investment horizons, alongside persistently low mortgage interest rates, now below 2% in some instances, are clearly enough to encourage existing homeowners to expand their property portfolios. Indeed, mortgaged investors had a 26% share of purchases in the third quarter of 2020, the highest figure since 28% in Q3 2016. This was just prior to the introduction of the 40% deposit requirement by the Reserve Bank. One thing the Reserve Bank will be paying attention to is the potential reduction in financial stability, given that has been their overarching mandate for the last decade. So then, the increase of investors taking advantage of the temporary removal of the loan-to-value ratio restrictions will be on their radar. The latest lending data reported by the Reserve Bank shows that in August, 35% of investor lending was advanced with less than a 30% deposit. A year ago, that figure was 22%. Investors aren't the only active players in the market though. The share of sales going to first home buyers of 25% was their highest figure on record, surpassing the previous peak of 24% in 2006-2007. KiwiSaver withdrawals remain one important factor in their ability to stay active in the market, with more than 44,300 withdrawals for first home purchases according to the latest FMA annual report to the end of March 2020. With all the election campaigning now done and dusted, we await our new government. The first few weeks following a general election are always interesting to see what promises, compromises and targets are set out. Housing came a bit more to the forefront in the closing weeks of the campaign, with a focus on improving the ability and speed of increasing supply. But ultimately, the more transformative policies came from the smaller parties, so any fundamental change will be reliant on negotiating power. Analysing the state of the construction market, so far, the industry has shown impressive resilience. Building consents issued have slightly tailed off, but Stats New Zealand's reporting of the number of filled jobs in construction has actually increased since the onset of COVID-19. Of course, the question arises about how many of those jobs are supported by the wage subsidy. And while the data isn't provided by industry, the overall figures are dwindling, with no significant signs of excessive redundancies following. In fact, the data are intriguing. At the peak of support, which was at the end of May, the wage subsidy supported 1.66 million jobs. The scheme closed to new entrants in September, at which point there were a total of 380,000 jobs being supported by the scheme. As of the 2nd of October, there were less than 95,000. By the end of October, the Ministry of Social Development project there will be less than 500 jobs being supported by that benefit. With our economy seemingly operating at near normal levels, despite closed borders, businesses have appeared to have survived better than first thought. And the winding down of the wage subsidy has had less impact than expected. The next major milestone will be the end of the mortgage deferral program, now pushed back to March 2021. But if interest rates reduce further and demand for property holds strong, it's hard to envisage a lift in motivated sellers causing values to seriously drop. Certainly short-term demand is looking very strong. According to the CoreLogic Early Market Indicators report, valuations ordered by banks for mortgages are up by 7% week on week, after a noticeable jump at the start of October. We'd expect this to persist through to Christmas at the very least. You never know what's around the corner though, and we'll remain on top of all the latest data releases and property market coverage. So make sure you don't miss a beat by subscribing to our weekly property market podcast and frequently checking out all the research content at corelogic.co.nz. Mā te wā.